This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. It is our first week of 2024, and gotta say, it was a busy start to the new year for markets with Federal Reserve meeting minutes being released. We also got the December jobs report. We also saw a risk-off trade for much of the week on expectations that the Fed now will keep interest rates elevated for longer. We've heard this before, Tim.
Perhaps not surprising, the NASDAQ, as a result, taking the worst of it. And so ahead on the program, we'll examine both the bull and the bear case for the index's largest holding, the ultimate mega cap, Apple.
Indeed. Also ahead, a wide-ranging interview with ARK Invest Cathie Wood, and you'll hear from Carnival CEO Josh Weinstein on what the cruise line can do for an encore on the heels of a strong quarterly earnings to cap off 2023.
Plus, our Bloomberg Pursuits team lays out the ultimate travel guide for the next 12 months, which spans destinations on 6 of the 7 continents. Sorry, no trips to Antarctica.
There's a story there, everybody.
And the Caribbean as well.
I'm already putting a list together of where I want to go. All of that to come. We begin with the very first Bloomberg Big Take of 2024. Covers everything, well, almost everything, that Wall Street expects in the year ahead. The range, everything from the mother of all rallies to a sell-off for the ages. Talk about a standard deviation, Tim.
For a look at the key takeaways from more than 650 calls from the financial world, we welcome Bloomberg News senior editor Sam Potter. And as a reminder, on our last trading day of 2023, our most read story on the Bloomberg terminal was about how Wall Street's best and brightest flopped once again in 2023. So our first question for Sam, what's the use in surveying Wall Street for what to expect in the new year?
Yeah, they really put me in a bind with that story at the end of last year. First up, I should just say these are the investment outlooks that the biggest banks, the biggest asset managers and advisors put out every year. They start publishing them in November. Many of them run to 100 pages or more, containing all the wisdom and the forecasts for the year ahead. I've been sort of collating the main calls for these for the last 5 years or so, 5 or 6 years. I've got to say it's interesting this time around because there is dispersion as ever, but actually there's a fairly common consensus among most of the reports, which is, and it's a pretty sort of benign, middle of the road kind of view that the rate hikes that we've seen this past year or two, they're finally going to bite. Economies are going to slow, and that will prompt a central bank pivot somewhere in mid-year, which could pave the way for a bit of a recovery. And modest gains for stocks and bonds are seen. So actually, most of the forecasts are sort of cleaving around this fairly benign outlook.
And that doesn't typically happen in terms of kind of a middle of the road thinking, Sam, since you've done this, for us a few times here at Bloomberg, is it more typically some extremes kind of all over the place?
So the reason that 2023 stood out so much and that my colleagues did that story last week was this time last year, everyone was very gloomy. They expected recession and not a mild recession. A lot of people were predicting that it was going to be a very tough year as those rate hikes really ground into the economy. And as it happened, the economy held up pretty well. You guys were just talking about that. And then an AI frenzy from nowhere stoked the stock market. And so everyone's forecasts were sort of torn up. This time around, as I say, it's a very kind of, the words they use are like a mild recession, a healthy slowdown, a benign. It's the soft landing, right? It's the successful soft landing, which most of the calls say. Not all of them, as we say. There are still some outliers, but it's unusually kind of conservative, I guess, this year.
It is, but there's also this section on risks that I wanted to highlight, Sam. What were some of the risks, or I guess what is the general theme that runs through the different banks when they talk about risk for this year?
Well, there's the big and very obvious one, which is the election year ahead, which has been talked about quite a lot. I think it works out that more than countries equating to more than half of the global economy will be electing their leaders in the year ahead, or are expected to, led, of course, by the United States. And at this point, that is just too too tough to call. All the reports all these poor strategists can do is say, prepare for volatility. It's too early to say. We don't know what's going to happen. So the US election is really a big one. Inflation, has it been vanquished? If it proves stickier than everyone expects, then that could be a bit of a surprise for the market. And also geopolitics. I think in the past 3 or 4 years, it's been the unexpected that has derailed all the Wall Street calls. So the war in Ukraine, and now we have Israel-Gaza. While there is consensus, there's a lot of nervousness, and we see generally risks stacked to the downside.
Yeah, I feel like the geopolitics, one of the things last week, it was so quiet. I mean, every morning we'd come in and futures were like 0.03. Like it was like barely moved. We actually got unchanged a couple of times. It was just so quiet. But we were concerned about geopolitics, certainly as we started to see problems in the Red Sea and, some of the big container shippers or the big, trading companies that are so important to moving stuff around in terms of our global supply chain saying, I'm not going to do it. Maersk, again, I think today or in the last 24 hours saying we're not going to send our ships through there. There's just too much risks at this point. I do feel like it's kind of wild here, Sam, wild in a scary way that we now have the Russia-Ukraine war headed for its third year, right? And then we now have the Middle East where it does feel like things are escalating, and that there's a lot of kind of hot points. People last week were talking about more than 100 attacks like in the region. So maybe we are already in a third world war. If you had to say, the biggest risk that maybe faces investors this year, is it geopolitics?
Well, funnily enough, geopolitics, I mentioned it after the election because that seems to be where it comes on the radar. Obviously, the US election in particular has a huge bearing on the geopolitics because the foreign policy of the respective candidates is likely to be quite different. I think geopolitics, a lot of the view is that the Russia-Ukraine war is kind of a known element now. Those energy shocks that we experienced in the early days of the war are not happening so much anymore. There are some rumblings, if the Middle East escalates, obviously that can impact the energy sector. A lot of, I guess, I don't know whether strategists are just getting weary but a lot of people saying, in the long run, the markets look through these things. They look past these things. So don't worry about it too much. Far more important is the election. And actually, one thing that we haven't mentioned is the fiscal picture, which is looming in the background, in particular in the US, because a lot of people are wondering if the US could keep spending the way it is and how that is going to feed into the election.
One thing I wanted to ask is AI was such a big momentum play, if you will, and actually turned out to be fundamentally, because we did see some strong numbers from NVIDIA. Is there something else that kind of juices the markets? AI did it last year, those, new class of weight loss drugs. Is there something in terms of a sector or trend? And just got about 40 seconds here.
AI still is what I would say to that. I mean, for the longest time, we all talk ESG and green energy and things, but it never sort of catches fire in the way AI did this year. So a lot of the outlooks are talking about the potential for AI to keep supercharging returns. And it's going to play out. They see it as a theme that's going to run and run over the next couple of years. So AI still, but there's these things by their nature come out of the blue, right? So if I'd seen the magic ticket in these outlooks, I would, I wouldn't be telling you guys, but
come on, Sam,
I would tell you if I knew.
You would quit. You would make an investment.
If Sam's not doing the outlook for 2025, we know he found the golden ticket. Okay, that's what we know.
That is so true. Didn't somebody win? Was it in Michigan?
Yeah, but I'm talking more important than the lottery is knowing what the market's doing.
Exactly. Sam Potter, thank you so much. We know it is later out there in London, so we were so glad we could bring this story to everybody. Sam Potter, Bloomberg News senior editor on Zoom from London. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. or watch us live on YouTube.
The 2024 trading year began with volatility for Bitcoin investors. Early this past week, we saw the cryptocurrency briefly touch $45,000 for the first time since April of 2022, before retreating. This on bets that the SEC will soon approve an exchange-traded fund investing directly in the biggest token.
Yes, indeed. We're watching the calendar. Now, one person who has long been confident in this development is Cathie Wood, the founder, CEO, and CIO of ARK Investment Management. She joined me and our Bloomberg TV colleagues, Katie Greifeld and Manus Cranny, on December 28th for a wide-ranging conversation, starting with ARK's move to sell off its remaining position in the Grayscale Bitcoin Trust based on the shrinking discount to its net asset value.
We're as optimistic about Bitcoin as we ever have been, but there are a few regulatory and tax uncertainties, and we had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally, and now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk.
Mm-hmm. And I mean, let's get a little bit specific here because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
But you've talked about January 10th, Cathie, I think in another report. Is that possible, whether it's you or somebody else, in terms of the first spot Bitcoin ETF actually getting approval? Well,
we think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try, dogged and determined. And so here we are. We think we're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us, it's others as well. We think a number of funds could be approved at the same time. And they've been asking not only one set of questions, but follow-up questions. And again, that's a very good sign.
Well, speaking of engaged, go ahead, please. No,
Yeah,
finish.
The last few questions have been very technical. And so more de rigueur, and you'd expect them to be asking these questions as we head toward an approval. Now, it's not 100% certain, and so we want to make that clear as well. this is the SEC, and we never know, what might happen along the way.
Regulators can be tricky, that's for sure. Hey, listen, you mentioned engagement. Let's talk about engagement with your funds overall, and especially the ARK Innovation Fund, up 72% year to date, easily outperforming some of the major market benchmarks, still down 65% from the high back in February of 2021. For you, though, a lot of critics. We bring up your name, we bring up ARK, and you have a lot of fans and you have a lot of critics. There's a lot of discussion. Does it feel, though, a little bit like a victory lap this year?
Well, we are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22, as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. And we would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape, because we are our companies thrive on deflation. Technologically enabled innovation is deflationary.
So, Kathy, a very good morning to you. It's Manus, first time we've met on. So we're going to move to a deflationary environment. We'll come back to the big macro call in a moment. Just let's square it away before I talk to you about the flows in the funds, which is how much interest rate cuts do you presume are you forecasting? Leave the forecast of everybody else aside. Well, what do you presume will happen next year?
Well, we put up a chart in one of our in the nose, which is a YouTube video that I do every month, Employment Friday. And in that chart, you will find a ratio. It's the metals to gold ratio. So metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November. And what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years. And interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation.
Okay,
yes.
Well, we'll come back to that and see whether we get to the 2% level. I've got to ask you about the flows into the funds, which is obviously, as Carol just said to you, you've got a bit of a victory lap going on at the moment, but this is the first year of outflows. Have those outflows stopped? You've had a great performance in the back part of this year. Have the outflows stopped? And has that bleed stopped?
Yes, well, we were very gratified at our asset retention in 21 and 22. In fact, we had net inflows, if you combine both years, of more than $18 billion. And this year, one might expect that those who averaged down into the very steep declines that we were seeing in 22 especially, might take some profit. So we have had, I know for our flagship strategy, it's roughly $500 million in outflows, maybe for all of our strategies, 1.8 million. So maybe 10% of the inflows that we enjoyed during 21 and 22. So again, we're very gratified and grateful to our clients for the support that we continue to receive.
So has the outflow stopped?
We have had days of On balance, very recently, yes. And I think part of this is many people do tax management toward the end of the year. And so some of the outflows might have been associated with clients who got in at a high cost base and were just harvesting some tax losses. But I think we're through that.
Do you find it a little surprising, though, Kathy, considering the run-up? Or I'm curious about the conversations you do have with investors, considering the year that you're having, and then to see those flows. It's got to be a little disheartening. Yeah.
Oh, no, not at all. Actually, we put out a piece for Resolute, our distributor, who, and we basically showed to them, if you rebalance our strategy when there have been big moves one way or the other, if you rebalance regularly or based on a rule like when the fund's up 15% relative to everything else, take some profits. And what it showed, that study showed that if you are disciplined that way, that over any rolling 5-year period, it is highly likely, almost 100%. I'm not quite sure if it's quite that high, but that you will beat the market, meaning as measured by the NASDAQ or the S&P, over a rolling 5-year period. And so a lot of our funds are with advisors who are very sophisticated and responded somewhat, perhaps in this tax management part of the year, to that message.
I feel like we have to talk about Tesla and Elon Musk. And I know you just had a conversation on Twitter, X. This has been, I think, from day one, right, in terms of you starting out, that you've had this investment in Tesla. And I remember when we first talked and you were getting started, you talked about him being the next Thomas Edison and how his vehicles would turn the U.S. economy upside down. Having said that, there's an evolution and the EV world has changed. How are you thinking? It's still a top holding. How are you thinking about the Tesla story right now?
Well, first of all, Carol, thank you very much for letting me interview that time. That was nearly 10 years ago. ARC is about to celebrate its 10th year anniversary, and you gave us that opportunity, so thank you. The world is evolving, actually, I think, even more closely to what we expected. Because we expected a lot of traditional auto manufacturers to see the writing on the wall and rush as quickly as they could into scaling big time into electric vehicles. And what has happened recently? Both GM and Ford have said, we're stepping back. We're not going to do this until it's profitable. The problem with that is, in order to be profitable, they need to scale. That's how this works. These are learning curves that they are riding down, and those are expressed in cost decline. So the fact that they're pulling back means there's more share for Tesla and others who choose to go for it.
And Kathy, I want to keep the conversation going on Elon Musk, but I want to bring it to the ARC Venture Fund. Of course, it's not an ETF. You invest in private companies, et cetera, in there. And you take a look at the portfolio, you have SpaceX in there, and you also have X, formerly known as Twitter. And in July, you had told the Wall Street Journal that you had written down your Twitter stake by 47%. Fill us in on the past couple of months. Have you written it down further, or how has that changed?
No, I think it's still there. We have to be very careful. This is an interval fund. It is a 40 Act fund, and we have to market every day. The good news is our clients can get in and have access to these amazing companies for just $500, and they get quarterly liquidity. So that's the good news. The markdowns are simply, if we see in the secondary market employee stock trading at a steep discount, we have to take that into account. If we see others in the more traditional asset management world, like Fidelity and others, marking their holdings down, we need to take that into consideration during our daily mark-to-market. So it's an abundance of caution. We have a 5-year investment time horizon. Do we think that's where X belongs in terms of valuations? Absolutely not. Absolutely not. A roughly $20-ish billion valuation for what we believe truly will become the everything app. Think WeChat Pay. Elon started his entrepreneurial career in the payments industry, and he's been thinking about this for a long time. He now has money transmitter licenses in more than half of all of the states, which we learned on Twitter Spaces, or on X Spaces, I should say, the other day when we had our interview with him. So that's exciting. He's going for it.
He's going for it. We'll see if that one lands. But let's talk a little bit more about the private markets, because obviously the private credit market has gotten a lot of attention right now. You're looking at the private markets through this interval fund that you have. When you think about the opportunities there on that 5-year horizon that you have, do you see more so in the public markets or in the private markets right now?
Now that we've had this very nice run this year, we think the answer to that question is in the private markets. They're close. They're close. What's fascinating to us is that the public markets have been leading the private markets for the past 3 years. As our funds were falling in 21, private valuations were going to all-time highs, along with the NASDAQ. They were taking their cues, I suppose, from the NASDAQ. But real innovation, if you looked at our portfolios, was starting to revalue to the downside, and even more so in 2022. We are still seeing major down rounds taking place in the private markets, and I'm always surprised at this sort of thing, because you would think that the private markets lead the public markets. That has not been the case in the last few years.
Hey, Kathy, I've got to be honest with you. I think whenever we think about Elon Musk, brilliant, but also erratic. And I'm curious how you think about Elon, the individuals, versus Elon, the companies he's creating, the things he's doing. Because I think there is time, any other CEO of a major publicly held company would, I think it's safe to say, not be able to get away with a lot of what he has done. So help us, educate us, how you make sense of it, of someone you have followed, talked with for many years.
Well, first of all, very often we just look at what he does, not exactly what he's saying, which can often be a distraction, or it can be an advertisement for his cars or for X or for SpaceX and so forth. So, but we have a scoring system as we are evaluating companies and their founders and their management teams. And there are 6 metrics, and one of them is moat and barriers to entry. And I think Elon is a maestro of raising barriers to entry with innovation, which that is so much faster than anyone else. Why? Because he's so first principles, physics driven in his analysis of how to approach a new idea, a big idea.
So tell me this then, Kathy. I mean, if you look at the cohort of the CEOs that you back, Brian Armstrong, does he hit that bar? Is he above Elon, or is he at the money? You've got Elon, you've got Brian, you've got Tony Wood at Roku. Does anybody come close to Elon, or is Brian Armstrong maybe even at the money with Elon or above?
We don't actually look at the world that way, one relative to the other in terms of management teams. We do look from our scoring system at the scores, which include moat, management, people and culture, execution, valuation, that might surprise people, and product and service leadership, and thesis risk. Those are the 6 scores. And all 3 of them score very highly. Which one scores the highest? They're actually very close to one another, to be honest.
They're very close to one another. So, I mean, obviously, Coinbase is one of your key holdings. We've talked a little bit about that. The other feature that we want to talk about is AI. I'm curious to know, in OpenAI, the valuations have ranged between 80 billion to 100 billion. Will you take a position in OpenAI? Is that going to be part of your holdings as you explore the next development of AI in your holdings?
Well, in our private portfolios, we are already exposed to Anthropic, which has been a major beneficiary of the drama around OpenAI that we all witnessed a few months ago. But if you look at GPT-4, which is the latest large language model that OpenAI has published, it is way above others in terms of performance. So there you have it, the pros and the cons. So we can't tell you what we're going to do in that portfolio, but we are so impressed at how OpenAI has led the industry. We're also impressed, however, at the open source models, and we'd like to encourage more of that movement. We know that Meta Platforms has with Llama 2, and it's working on others, is moving very quickly and making great strides. So for much lower cost, open source is free, companies can get close, not right at GPT-4, but close. So we want to see the open source movement. In the venture fund, we also own...
Kathy, we've got to...
sorry.
No. We never have enough time with you. Can I ask you a really quick question, 5 seconds?
Sure.
Any new ETFs coming our way from you guys next year?
Well...
real quickly.
As you may know, we bought a company in London.
Yeah.
They have some very interesting funds.
Our thanks to Kathy Wood, the founder, CEO, and CIO of ARK Investment Management, joining me, Katie Greifeld, and Manus Cranny on December 28th.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One bad apple don't spoil the whole bunch, girl. Oh, give it one more try before you give up on love.
All right, everybody. Apple slumping the most in September. Shares down 3.6% after Barclays cutting their ratings and price target on the stock. Analysts, they are bearish over an expectation of soft demand for the latest iPhone and a lack of new features in the next iteration of the iPhone, arguing that it's just not going to prompt customers to go out and upgrade. I don't know. I need a new phone. I need a new watch. There's a lot of Apple that I have to
definitely need
buy.
a new watch. You have like the first
it's an
version of the Apple Watch.
Antiques Roadshow is calling.
Which phone do you have?
12?
Okay, yeah, you should probably get a new phone.
Well, Dan Ives has the opposite take. He is not a bear. Just a couple of weeks ago, coming out with a note that argued that Apple is going to be the first $4 trillion market cap company, and that will happen by the end of this year.
It's $2.8 trillion right now.
Yep, so a little ways to go. He's got an outperform and a $250 a share 12-month price target on Apple. Dan, by the way, Managing Director, Senior Equity Research Analyst at Wedbush Securities. He's joining us from New York City on the phone. Hey, Dan, so good to have you here. My new year already feels better. What do you make of this call at Barclays? I'm going to assume if you were in a debate, you'd be like, nope, you got it wrong.
I mean, it's like Groundhog Day, the movie. Look, we've seen this before, right? I mean, every year, the fire in a crowded theater, first few days of the year scares everyone. The reality is, I mean, as someone that spends so much time in Asia, this iPhone 15 upgrade cycle has actually been strong. I mean, China has come through, I think, actually much better than feared. It's about the install base that many just continue to underestimate. You're talking about the best install base in the world, services, double-digit growth. I think a year from now, this is going to be a $4 trillion market cap.
What do you make of the channel check weakness that Barclays analysts are talking about? Are you not seeing channel check weakness?
I mean, look, everyone has their opinion, but for the last year, people have talked about channel check weakness, and it's essentially been a fictional Netflix story, in terms of what's actually come through. I'm not saying it's roses and champagne, but when I look relative to street expectations and relative to the upgrades, I mean, Tim, we have not seen any cuts at this point in the cycle out of our Asia supply chain checks. And you would have already seen that now. And I think look, Apple's like Rocky Balboa. Every time they're like, it's over. It's done. The growth's done at $1 trillion, $1.5 trillion, $2 trillion, $3 trillion. And I think that cycle it speaks to our view of we're in the beginning, in our opinion, of a new tech bull market. And to be bearish on Apple going into this, it's the exact opposite of what we would be doing.
Having said that, Dan, up almost 50% last year. Is there some expectation that some investors are going to be taking profits, that there could be a little bit of a pullback after such a run like that? I mean, do the fundamentals justify that almost 50% run up in 2023?
Yeah, and you look, and we've talked about it. You're going to have pullbacks like we always do, and pullbacks are healthy. But from a valuation, I mean, our view, it's a sum of the parts. And that's really what started to happen with tech, with the godfather of AI, NVIDIA. We've seen it with Google. We've seen it with Microsoft. That's what's happened with Apple. I mean, when you look at the valuation today, this is Apple with zero valuation for AI, which is going to be the next phase of the story. So our view is we'll have some ebbs and flows here, but this is one where fundamentally we continue to think it's one where it goes higher on multiple, it goes higher in numbers.
Does Apple, like I'm looking at revenues for 2023, Greater China was about almost 73 billion. Americas as a group, 162 billion. So certainly the biggest market. Will there always be a Chinese market for Apple products, in your view?
I mean, and look, and I think, and Carol, it's important because if you go back over the last 7-8 years, the bear story in Apple, if you go back 2 trillion ago, it's China, right? Eventually, that's the big bad one. Eventually, that market domestically, geopolitical. The reality right now, 20% iPhones coming out of China. And you have 100 million iPhones in China just in an upgrade opportunity alone. So that's something where the growth continues to actually expand in China for Apple. And I think you'll continue to have this as kind of a debatable point. But this is something that's just going to continue to expand, not contract, relative to what the average Chinese consumer wants.
Well, it's interesting because we just talked about ASML and the Biden administration putting pressure on it to not sell some of its really key China semi-manufacturing equipment to that country. Do you think geopolitics between the U.S. and China ultimately find a way to get along? Or does that continue to, though, like I just wonder, doesn't it eventually make it more complicated for a company like Apple? Although Apple very important to China in terms of the amount of workers it's got putting to work.
Yeah, I mean, at peak, it's second biggest employer in China, right? And I think even look at Tesla today. China numbers strong. So I think when you look at the political, sort of tightrope that's happened right now, because it's an AI arms race. So let's just call it between U.S. and China. And right now, because of NVIDIA, because of Microsoft, I mean, U.S. is actually ahead. It's going to be a balancing act, but our view is geopolitical is a background noise. I mean, this is the biggest tech transformation we've seen in 30 years, and it's one you're always going to have these worries. The reality is it's a dysfunctional relationship that continues. They both need each other in terms of U.S. and China, and that will continue to go down this path. And actually, the tensions, I'd say, if anything, has maybe been toned down a bit relative to what we've seen over the last 3-4 months.
Hey, Dan Ives, want to get your take on another part of the Barclays downgrade, which has to do with the iPhone 16. It's a little early for us to be talking about the iPhone 16 after all these things are unveiled usually in September, but analysts at Barclays argue that there are no features or upgrades that are likely to make the iPhone 16 more compelling. What do you make of that?
Look, they're probably the same ones that said you wouldn't have a Big Ten team in the national championship, and now you have 2. So,
Touché.
look, it's always going to be, it's easy to take shots, right? But the reality, you're talking about 2 billion iOS devices, and you have 1.3 billion iPhones. That upgrade opportunity alone is going to be 240, 250 million units. And you look at iPhone 16, it goes back to Apple. They play chess, others play checkers. That's why most valuable company in the world. But you will look, the haters are going to hate. And you're going to come out, especially coming out of a new year, the fire in a crowd theater call. I get it. We've seen it many times in our almost 25 years covering tech. But we view it as a golden buying opportunity, not time to hit the the elevator for the sell button.
So what brings Apple to $4 trillion? What is the next big thing from Apple? What's the one more thing, as Steve Jobs used to say?
It's good. And look, and obviously, one of the best thought leaders out there, Gurman, talks about it a bit, but it's AI. I mean, you have the biggest install base in the world. It's about monetize. We view it as going to be an AI app store. It's going to be ultimately something that gets rolled out over the next year, and this is going to be AI apps within the services flywheel.
But is that Vision Pro? Is that the conduit? Is that the device? Is that the platform?
Vision Pro, from a form factor, is the early stages of where this is all heading. The quick take would be like Vision Pro 3500. It's not going to change that's not really a focus Vision Pro, because 2 years from now, it's going to be a $1,200, basically look like sunglasses. It's all about developers now. Developers are going to build more and more apps. They're going to be AI generate, AR, VR. And that's going to further mine to the install base. But Tim, it just goes back to when they released AirPods, and everyone's like, if they sell more than 5 million a year, that would be the most unbelievable eighth wonder of the world.
I think I bought 5 million last year.
At peak, they sold 98 million in a year. So I'm just saying, Apple's one. It goes back to Rocky Balboa. Just continues to think it's over. Next thing you know, you're watching Rocky 8.
If, though, some of what Barclays comes true, and there are some issues, would you start to rethink a little bit differently, or would you just say maybe this is a little bit of a slower year than we thought?
I just view it as here and there, even some conservatism. I view it as overall slight turbulence chop that's ultimately going to 40,000 feet with smooth air in terms of where this is all headed. So that's sort of my view in terms of how this is going to go. I'm not saying it's not going to be, you're not going to hit some chop getting there, but that's the nature of Apple. That's how it always is. And that's why you're always going to have ones where the skeptics try to say this is the year it's over, innovation's done. And yet at the top of that mountain is Cook and Cupertino.
So what about Musk and Tesla? A little bit of a transition, not a good one, sorry.
Another,
but you've got an outperform. You've got a $350, I think, a share price target on this one. Some news about them falling behind BYD in quarterly EV sales growth slowing. What's your thoughts on Tesla here?
I mean, deliveries today was to flex the muscles. I mean, beat the street. China, a lot of the price cut, that price war has actually subsided. Strong China numbers. Cybertruck, we look demand to supply is 10 to 1, in terms of what we see out there. And I think this is actually the next phase of the Tesla growth story that's coming in the next 1, 2, 3 years in terms of full self-driving, supercharger, as well as they, ultimately they're diving into the deep end of the pool. Others are peeling back in Detroit. So for Tesla, it's another one where many continue to bet against Musk and Tesla. That's been the wrong bet.
How do you feel, Dan, about BYD? It's now ahead of Tesla when it comes to quarterly EV sales.
I mean, I'm a big fan of BYD. What they've done, I've seen it firsthand, is amazing. It's a 2-horse race in terms of essentially what's happening here. But this is not a zero-sum game. In other words, there's not just one play. We're talking about the biggest the biggest transformation to the auto industry since 1950s. The green tidal wave that's come. And others will say, EV demand is
Yeah, that's what I was going to say. Is the demand there? I was having a conversation with my dad about this, who loves his EV, and, he has a Ford. And I've talked about this a lot, Carol, but, he took him so long to get it after he ordered it, Dan, and now they can't get these things off of lots. because people aren't buying them. And he had a good point. He said, everyone who has an EV actually wants them, and you can get an internal combustion engine car for a lot less money. What about the demand question, Dan?
And just got about 30, 40 seconds.
I mean, for demand, I think it was maybe overestimated a bit, but we're still going at 25, 30% of automobiles are going to be EV from 3-4% today. And that's why eventually, likely, your dad might be driving an EV in the near future.
Oh, he's got the Mach-E. Loves it.
But he had to wait forever,
Exactly.
right?
Yeah, he had to wait forever.
To get it.
My mom loves it too. She drives it more than my dad does.
Dan, do you drive an EV? Just quickly.
Yeah, so and I'm also on the Cybertruck list. So when I'm in the Cybertruck, I'll pick you guys up on Lexington, and then we can drive it.
Deal.
Sounds
Dan
good.
Ives, such a treat. Great to have you here on this first trading day of 2024. Only thing is, I wish we could see you because you are a killer dresser. And it's always
Next
fun.
time.
Yeah, next time. Get home safely. Dan Ives, Managing Director, Senior Equity Research Analyst at Wedbush Securities, talking to us about Apple and Tesla, two of some big outperformers last year.
He's bullish on 24.
He is indeed. All right, you're listening and watching Bloomberg Business Week. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Business Week, including a trip around the world, literally, courtesy of Bloomberg Pursuits. Find out which destinations from nearly every corner of the globe need to be on your itinerary in the new year. And we're going to also tell you when to go, which is really kind of cool about this
Can we go now? Somewhere?
Yes, please.
And speaking of travel, Carol and our friends from Bloomberg Television sit down with the head of the world's largest cruise company and operator. Carnival CEO Josh Weinstein offers his view on the health of the consumer and explains why few can compete with the level of hospitality that his firm has to offer.
First up this hour, we continue our look at Apple and its potential hurdles in the coming months. No American tech company has bet as heavily as it has on the economic interdependence of China and the U.S. Quite simply, Apple needs Chinese workers to make its iPhones and Chinese consumers to buy them.
So this would seem to make the deteriorating relationship between the two global superpowers, the U.S. and China, uniquely dangerous for Apple. Remember, Biden launched an aggressive campaign to keep China from developing advanced semis and called Chinese President Xi Jinping a, quote, dictator. And then Xi pursued a strategy to limit China's reliance, Carol, on Western-made technology. But
back and forth.
Apple shares of Apple were up 50% last year.
Yeah, they did really well. So let's get into it because while the company's floated above the geopolitical tumult so far, Apple does enter this year, 2024, in danger of getting dragged into it. So writes our next guest. Not a guest. He's a friend of the show, friend of the family. Bloomberg Businessweek columnist Max Chafkin, who joins us here in our Bloomberg Interactive Brokers studio. His story, by the way, in the new issue of Bloomberg Businessweek, which is already, by the way, the story available at Bloomberg.com/businessweek and on the Bloomberg terminal. Happy New Year.
Happy New Year.
It's going to be Happy New Year for Apple.
Well, look, Apple is a big and powerful company, and what we're talking about are certainly challenges, but probably not existential challenges. I mean, when we take a few steps back, there are a few companies that are as sort of bought into the idea of U.S.-China relations being fairly warm. And that goes back decades. When you talk about Tim Cook, where did he come from before he was CEO of Apple? He was essentially the architect of this supply chain, the supply chain that relies on these big outsourcers, most of them operating factories in China to manufacture phones, and relies on a market, a market that has grown tremendously and has done really well by Apple over the past few years. You might have thought during the Trump presidency, Trump, a lot of anti-China rhetoric, a lot of rhetoric about globalization. Apple did great. And one of the reasons Apple did great is because although the trade war did not affect Apple, it did affect Apple's competitors, primarily Huawei. Mm-hmm. So for several years, Huawei was essentially frozen out of the market for high-end chips. It had, in 2019, Huawei actually surpassed Apple in terms of handset sales globally, in terms of units sold. And then it basically fell off a cliff because it lost access to semis, to the high-end semis. And what happened last year is that Huawei, basically out of nowhere, and we've talked about this before, launched this new phone, the Mate 60 Pro, that has a chip that is, although it's not quite a state-of-the-art chip, it's a lot closer than it was. That phone has sold very well. Huawei is bouncing back, and that is creating problems for Apple in China at the same time that the Chinese government is introducing new restrictions that the U.S. has characterized as retribution for our own restrictions. China has been sort of opaque about what they're doing, but it seems like, according to Bloomberg reporting, that many Chinese workers at state-backed companies are being encouraged or told or required not to bring iPhones to work. So you have these two sources of pressure. One is competition, the other is government regulation, and they're biting Apple, in a very important market.
Max, I think a big part of this story also is the fact that the ecosystem, the mobile ecosystem in China, is not as sticky as the mobile ecosystem in other parts of the world. So here in the US, if you're an iOS or an iPhone user, your next phone is going to be an iPhone because you're like in that ecosystem. You have all the apps. But then in China, you have these over-the-top payments apps that work equally well, whether you use an Android or whether you use an iOS device. We don't have that. They don't have that stickiness that we have here with like iMessage and other parts of the Apple ecosystem.
Well, and a big point, when you think about what is appealing about an iPhone, obviously part of it is the hardware. It's very beautiful, works fast, good chip, so on. But the software part is important also. And of course, software in China and these cloud services are regulated differently. Chinese users may not have access to all of the cloud services that US users have access to. So that's another factor. And of course, there's been a lot of sort of media coverage around this issue. In China, there's talk of sort of patriotic duty to buy, phones made by domestic companies, just as there is, I guess, to some extent, in the U.S. But until recently, that hasn't had much of an impact. And one reason it hasn't had much of an impact is because you haven't had really strong competitors. But now, talking to analysts and so on, the competitors are getting better. They're closing that gap with Apple. At a time when the government may be more interested. The government has long been interested in sort of reducing the, influence of foreign-made technology equipment, but where the government now seems to be sort of doing something, acting on that interest.
So does Apple have to be worried about China, especially, consumers wanting their devices or being able to do it? I feel like we have had bull-bear scenarios as of late in the last week or so, where there's some concerns about the uptick in China, specifically of the iPhone. So does Apple need to be worried? I mean, it also employs a lot of workers, which is a good thing for China.
So when you when you hear what Apple's saying publicly, what they're saying is, they're not seeing this. They're not worried. They've sort of signaled that the softness in China was not, in the most recent quarter, was not related to this iPhone issue.
And they still sell a lot.
And they're selling a lot. And we write in the story, there are big lines, at Apple stores. The fact is that this is a device that whatever the government says or does, and whatever's happening politically, is popular with consumers. People like it, and the same way they like it here. So that is all stuff that is going for Apple. And again, when you look back historically, we've sort of talked about this, and these warnings have been swirling around for like a decade, and Apple has basically done well, has continued to grow its sales in China. Now, sales may be plateauing to some extent, but now, people are raising concerns that we may be turning some kind of corner.
Can you talk a little bit, Max, about how this is a function of Tim Cook before he was CEO? I mean, this is a guy who was a supply chain expert before he was tapped to become interim CEO and then, CEO when Steve Jobs died. How did he set up Apple in China?
Well, and this is like such a fascinating thing because people think of Apple as this design-first company, and you might think that the successor to Steve Jobs would be another, head in the clouds, creative type. And of course, that's not what Tim Cook is. Tim Cook is a practical-minded supply chain whiz. And, it's worked incredibly well when you look at the number of devices, the way they've been able to squeeze costs to make this thing cheaper, to maintain their profits. I mean, a huge percentage of the profits in the smartphone industry generated by Apple. It's all kind of worked well. Then again, it's built on a vision of the world that is changing, and that will continue to change, assuming that the U.S. and China tensions between those two countries continues.
On those supply chains, you're right. The supply chain diversification, right? Because Apple is looking at other places, but might be, it looks like it's a way to reduce Apple's exposure to geopolitical blowback. it may be having the opposite effect. And you're right, Apple's a major employer in China, and the government crackdown on iPhones could be seen as a warning about moving jobs out of the country. That part of the story just kind of blew my mind because I don't know that we've really thought about it that way.
Yeah, so that's the thing. I mean, Apple sort of seems to have dispatched executives. Tim Cook flew out there at the beginning of 2023. A senior Apple executive made public comments, kind of a rare interview with state media, talking about the kind of joint relationship between the two countries. Apple's really interested in sort of promoting the idea that, hey, it's been a really good employer in China. Yes, it is interested in diversifying its supply chain, as are many companies, of course, because as we've seen with COVID and so on, there are reasons for that. But it's hard to escape the sense that they're in a bit of a box. They have to, or that they at least have to walk a line where they want to diversify their supply chain. They're trying to make more iPhones in India, both for reasons of diversification because they want to reach that market, while at the same time trying to make sure that they keep those relationships in China that Tim Cook and this company have spent decades building intact. You know, they definitely can't just turn off the iPhone factories in China. China's going to be important to Apple, for many years going forward.
God, it's fascinating, right? It's like we'll see what happens in the new year. It's hard to be Tim Cook and kind of juggling it all. Max, great piece to carry out into the new year. Max Chafkin, columnist at Bloomberg Businessweek, coming up in the new issue of Businessweek. It'll be out next week, but it's already on the Bloomberg terminal at Bloomberg.com. Max, thank you so much. Happy New Year. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Cruise stocks led the travel and leisure industry as one of the market's best surprises in the past 12 months. And yet they slumped in the first trading days of 2024.
Well, our Bloomberg News team says the early losses are evidence of just how demanding investors have become for the top cruise lines to offer fresh catalysts after a banner 2023. Resilient consumer spending habits led all three major cruise stocks to post their best annual gains since going public.
The biggest of the three, Carnival, came out with fourth quarter results that beat estimates late last month. And S&P Global Ratings upgraded Carnival's credit rating 2 notches on its strong booking figures and higher prices. CEO Josh Weinstein sat down with Carol, Manus Cranny, and Katie Greifeld on December 29th for a closer look at the numbers and at the consumer.
2023, we wrapped in November, on November 30th, and the one word that we like to use as a summary is record. We had record demand, record yields, record pricing, record bookings, forward bookings, record onboard spending level. So really across the board, our business has really thrived in 2023, and we expect much more in 2024.
It can continue because you're such a great gauge of how customers are feeling. You have several brands, but you really kind of speak to the everyday U.S. consumer, if you will, and you just have a great read on it. Are they continuing to spend? Are they continuing to do advanced bookings? And then once they're on their ships, Josh, continuing to spend as well?
Yeah, that is exactly what we see. As a matter of fact, our Q4 was, from a pricing standpoint, the highest all year. So it's accelerating; it's not decelerating. And then when we look forward, we're actually 2/3 booked for all of 2024 already.
It's nice visibility.
It's not too bad. We're about 10 points higher than we were last year. And on top of the ticket bookings, we've actually started pulling forward onboard spend. So we have more or less about a third of our onboard spend being prepaid in advance. So we have a really good amount of visibility. And those booking trends, they just haven't slowed down. Every quarter this year, people expected it's gotta slow down. We're gonna see something. The consumer's gonna get impacted. And the fact is, with our business, we haven't seen it. It's record after record. As a matter of fact, we just ended the 2 weeks of Cyber Monday and Black Friday at more records. And it's not just coming from one brand. It's not coming from the United States. It's global. It's with our global portfolio of brands, which is really, really encouraging.
Do you think we're moving from many CEOs similar to yourself that I've sat with that run global airlines and global businesses have said, we've lived through a period of revenge tourism. We were all locked up for a period of time. This is something, we had this parabolic reopening and you had a parabolic rebooking. Are we evolving into some kind of new cycle? You say there's no end in sight in this demand. So if we've ended revenge tourism, how do you describe the next evolution?
Yeah, that's a great question. So we don't think this is revenge anymore. This is not pent-up demand. It's 2 years on from when we really got back in full as a corporation. This is people who have decided what's meaningful for them. How do I want to spend my life? And experiences are what they're looking for. Unforgettable memories and creation with friends and family. And that's exactly what cruising has to offer.
And that's what I sat down with the Accor CEO and he said, look, I haven't got enough hotel rooms and I haven't got enough high-end staff to help me run this business, which then takes me to the cruise is the high-end hotel. But to what extent are those packages off ship and onshore, those additional spends, are they critically important to the expansion and the turnaround from the loss that you've had? Do they add incrementally or significantly?
So, when we think about our business, we're a little bit different from when you're looking at hotel companies. I'm staying in a hotel in New York, and I won't tell you which one it is, but I'll tell you the service is not very very good. And we've learned how to live with that as a society. It's almost a tacit acceptance. No, we should not. No. And the cruise industry, our brands did not deviate from service level. Our guests have high expectations and we aim to exceed them. We do not close off floors. We do not shut areas down. We do not skimp on the services that we used to offer. It is full steam ahead, and that's what people expect, and that's what they're willing to pay for, and that's what we're seeing.
And let's talk a little bit about the fact that you are a global brand, of course, a global company that goes many places in the world. I don't need to tell you that the geopolitical landscape, very fraught right now, 2 hot wars, and of course, conflict in the Red Sea. Has that impacted at all where you can go? And are you seeing any inflationary pressures from some of the things that we're talking about here?
So the second question is no. We haven't seen anything of note. Obviously, we pay attention to crude prices, which is a good barometer of a lot of things. With respect to the impact on our business, we had about less than 1% of our business touching Israel in one way or another. Not necessarily home porting, but it might be one transit stop on a world cruise or something of that nature. We made changes some time ago. We actually don't have any ships transiting the Red Sea area for several months. And so obviously safety first, and we have mitigation plans should we need to adjust where those ships would be transiting. But as of now, we're in a watch and learn mode.
Let's also talk about your bond book, because it was interesting seeing just last week, actually S&P coming out and upgrading Carnival, not quite back to investment grade territory, but you're getting closer.
2 notches higher.
Two notches higher. On earnings day, actually, you think back, and the chief financial officer of Carnival said that there's a real possibility that Carnival will come back to the debt markets in 2024. Where's your current thinking on that, and what would actually bring you back to the debt market?
Well, really, the only thing that would bring us back to the debt market, as far as we can see, is if there's opportunity to refinance on more favorable terms.
So lower rates.
Yeah, lower rates. We're not, or managing our maturities, but we're not looking to lever up. As a matter of fact, as you said in the intro, we've managed to cut down our debt load by about $5 billion so far. And we expect much more of that as we go forward. That's priority 1, 2, and 3 when it comes to our capital structure, delever.
Hey, one of the things, and it kind of ties together geopolitical, but also kind of, where you're thinking about growth. Saw a story that the first domestically built ship in China getting ready to hit the high seas, but it's a joint venture. You guys are involved in this. And I think about how important China is for you guys, but also geopolitically concerns about China, its ambitions with Taiwan, and whether or not there's going to be some problems there down the road.
Sure. Well, we're very happy for the folks at the China JV. We actually unwound the JV earlier this year.
You did?
We did. So we've been providing shipbuilding expertise support for them, and we were very happy to do that. And we're
the story still says you guys are involved, but go ahead.
Well, that could be how we're involved at this point. But from our perspective, we got a portfolio of world-class brands all over the world, and that's where our focus is. It's great for the cruise industry that China has opened up, and it will be opening up for international cruise companies. We're not going to be one of them that's going back in. We've got our assets where we want them. We've changed our asset strategy. We've moved ships to different brands to accommodate the change in China, and they're doing very, very well. So we'll take a wait-and-see approach on that as well.
But not a market you need to be in right now, just
no,
quickly.
It's definitely not.
That was Josh Weinstein, the CEO of Carnival, with Carol and Bloomberg Television's Katie Greifeld and Manus Cranny back on December 29th.
Still to come on Bloomberg Business Week, the best new resorts, restaurants, and museums to plan a trip in the year ahead.
Malta is a place that I have always kind of been interested in. It has so much on just a couple of islands. And you think of Malta as like old cities, kind of like Game of Thrones type stuff, but it's also got beautiful small towns, wonderful countrysides, feels like Sicily.
Bloomberg Pursuits unveils its data-packed guide to your 2024 in travel. That's on the other side. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
The International Air Transport Association predicts that 4.7 billion people will jump on planes in the coming year, generating some $964 billion in airfare alone. Wellness tourism also poised him to reach the $1 trillion mark this year. I just want to go places.
People want to get pampered, too, when they
Yes.
go places. With travelers looking for new hotels that dazzle and impress and experiences to match, it's creating opportunities for less heralded destinations to emerge. Our friends with Bloomberg Pursuits have sorted through all of the contenders to determine the 24 most exciting places to travel in 2024. And, of course, the ideal times to pack up and go. What a tough job that they have. I feel so bad for them.
Yes, indeed. My heart bleeds. All right, this story will appear in the year ahead issue of Bloomberg Business Week. It's available now at Bloomberg.com/businessweek and, of course, on the Bloomberg terminal. Here with a breakdown are Bloomberg Pursuits editor Chris Rausser and deputy editor Jim Gaddy. And, Chris, I want to start with you because there are lots of places, or both of you, guys, where we can go. So how do you guys put this together? What's kind of the jam session that you have to kind of figure it out?
So we keep track of places throughout the whole year, and we start working in like August on this particular project.
So it could be March, and you're like, "Oh, guys, that's gonna be one for the end of the year."
Yeah. And what we do particularly is we focus on destinations that have news in them. So like some of these other lists, it's like, have you never heard of this place? Go off the beaten track. For us, is there more air access? Is it easier to reach than it has been in the past? Are there more luxury hotels or more safari trip opportunities? Or is there just more stuff to do? Is a city having a major development boom? Are there lots of new reasons to visit a place? That's how our list is determined.
All right, so it's not alphabetical or anything.
You don't pick the names out of a hat. Jim, what about sort of the on-the-ground research that goes into not just determining the places, but also making sure that you have a good idea, that you and the team have a good idea of what can be found at these places?
Well, I have to give a shout out to our travel czar, Nikki Eckstein.
She's amazing.
It really works with people on the ground. As you know, we have many bureaus around the world. We work with those bureaus to identify places that have this business opportunity. And Nikki is in touch with them all year. We have freelancers that also are on the ground that sometimes go to these places specifically to write up. Sometimes we think of these as like, maybe we'll do something bigger on these places later in the year in 2024. So we have people, this is kind of like our scouting trip.
I say it every year, but like, I never get the call from you, Chris. It's like, hey, we need you to go to Aspen in February to just check it out and
Tim,
make sure that the
I have a surprise for you. Do you want to go to Aspen in February?
I do want to go to Aspen, do some skiing. Yeah.
All right. Let's leave our children with our spouses.
Sounds good. We're there.
Sorry, guys. So Aspen's on the list.
Yes, Aspen is on the list. So, and I've never been to Aspen, and because of all this, I think
Tim,
I'm going to try to go in March.
We should go, Chris.
Yes, Tim, come with me.
It's a good time.
Seriously.
February, March, it's a good time to go.
So Aspen, is so well known for all the restaurants and the fabulous hotels and the sort of luxury that's there. But what hasn't sort of grown a lot in decades is the actual ski terrain, and they've added a huge whole 153-acre part of the mountain, which mostly shoots and glades and stuff. So that's like an exciting reason to go this year. And there's half a dozen new restaurants.
Is there snow?
There's more snow than there is in the Northeast.
That's true.
Not as much snow as in Switzerland.
But you were saying lots of restaurants.
Okay, so there's half a dozen new restaurants, and then a bunch of there's a new hotel called the Molly Aspen. It's the first new hotel in 5 years, and then a lot of the hotels that are already there have undergone renovations. So the St. Regis is like totally redone. They have this fabulous new spa. So there's a lot of reasons to go both on the slopes and off.
I wonder too, like as you guys go through the list, Jim, like was there a favorite place that you're like, oh my God, I didn't know, or as you guys were reporting and writing about it, you're like, like, I'm going to go there?
You know, I was talking about this with Chris before we came over here. One of my favorite categories that we do is the place that you thought you knew, but is totally different now. Las Vegas was an obvious candidate for that. They're on the list. Cayman Islands. Carol, did you know that they have a thriving art scene?
I had no idea. I've gone there diving, but no, I did not know they have a thriving. I thought it's a place to park your money.
Yeah.
But who knew?
In February and in May, they have these huge arts weeks. And so that was something that kind of appealed to me. Someone who loves going to the beach and also likes going to museums. You kind of get the best of both worlds there.
Let's go back to Vegas for a second, because for me...
Tim, what happens in Vegas?
No, I mean, to be honest, for me, Vegas has been, every time I've gone to Vegas, it's just been a drag. I mean, it's like you're here for some conference that you don't want to be at, and you're stuck in a casino. Now there's the Sphere, which everybody's talking about.
He's obsessed with the Sphere.
I would love to go to the Sphere. What else does Vegas bring to the list?
Well, you know, they've kind of reinvented themselves as a sports destination. The Super Bowl is there in February. Formula One has a presence there now. And there's a big fine dining restaurant scene there. You know, I mean, I don't know if this counts as fine dining, but, you know, Hollywood star Jon Favreau is opening up a food truck with Roy Choi this year.
That's Bruno Mars. Swingers, right? Remember Swingers? It was in years ago where he like drove from LA.
He's a major Hollywood director, but that's okay.
What'd you say?
He's a major Hollywood director.
I know,
but
but
okay.
You're so money.
Every time I've been to Vegas, I eat well. I've seen shows. It's kind of fun.
All right,
it's
we
like,
got to go to Vegas together.
Have you gone lately, Tim?
Have not. Carol and I went a couple years ago.
You just go to like those.
We went for like 16 hours.
Yeah,
Carol,
if you've talked to anyone who's gone this year, they will rave about it.
Okay.
Seeing Adele, seeing U2 at the Sphere, people are thrilled with Vegas.
Kate
now.
saw Beyonce twice.
Hannah went to Formula One. You know.
All right, there's a lot.
Tim, you just need an education in
Okay.
Vegas. I had no idea. Sometimes maybe I'm just an idiot, but Transylvania, it's actually a real place.
Thank you for admitting that, Carol. You heard it here first.
No. We actually have someone in our makeup room. He's from Transylvania.
What? And did you ask him if it was a real place?
I did. I was kind of like, he kind of laughed.
So Romania
He doesn't work on me anymore. Just kidding. I'm just kidding. Okay, so tell us about that. It's real.
So
Romania.
Transylvania is a region in Romania, and it's incredibly beautiful. If you've ever seen pictures, it's these craggy mountains and these old, monasteries and churches that are literally 1,000 years old. And you can stay in a hotel that's from the 13th century called Bethlehem Estates. It's an old ancestral manor now. There's a bunch more sort of luxury destinations, hotels, kind of like rural farmhouses turned into sort of luxury camps.
What's also really cool about this is it's affordable. I mean, luxury hotel prices, according to the chart that you guys have in this story, they don't even top $200.
Yeah.
Like that's pretty great.
Mm-hmm. And it feels like you're in a, you love how you love a place that feels like you're in a totally different world. It's exactly that. You can go hiking. It's quiet. It's incredibly beautiful. You can see Bran Castle, which is theoretically where Dracula lived and is in the movie Dracula.
I want to suck your blood.
And I should say, it wasn't Dracula, guys.
Wait, he's not
wasn't
really.
saying it
He
wasn't
was real,
the three of
wasn't
us.
he? Wasn't he real?
He was real.
That's right. You know, it's funny that you talk about affordable, though. And before we move on to something else, Argentina, you guys point out because of soaring inflation, like a dollar's going to go really far. No easy segue. But Chris, do you have a favorite place in here that you were like, you know what, I got to put this on my list of places to go?
Yes, there's actually a few, and Transylvania was one of them. Malta is a place that I have always kind of been interested in, and it has so much on just a couple of islands. It has the opening picture on our story is these crazy caves on one of the islands in Malta, which just looks like somewhere that shouldn't exist in the world.
I have to say I'm obsessed with some YouTubers that sail around the world, and they go to the Mediterranean, and they've been here, and they just you see them kind of like just mooring there, and these places are stunning.
Yeah. And you think of Malta as like old cities, kind of like Game of Thrones type stuff, but it's also got beautiful small towns, wonderful countrysides, feels like Sicily. And, as you mentioned, Tim, if you go to the web version of this story, you'll see that we have luxury hotel prices from Kayak, so you can see when prices are high and prices are low. And we talked to local travel agents to say, like, okay, maybe the prices are low because you shouldn't go at this time of year. So we match up the good hotel prices with the right times to go.
All right, guys, thank you so much. Happy New Year to both of you. Our thanks, as always, to Bloomberg Pursuits editor Chris Rouser and deputy editor Jim Gaddy.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Carol Massar along with Tim Stenovec. When you look up the most enviable job in the encyclopedia, you see a picture, no doubt about it, of our next guest. We're talking about Hannah Elliott. She's auto columnist for Bloomberg Pursuit. She's also the co-host of the new podcast, Hot Pursuit. New episodes are dropping weekly.
So here's what that means. She flies around the world, drives new cars, and gets to write about them for Bloomberg News. She got to drive about 30 different vehicles last year, from Porsches to Rolls-Royce to Lamborghinis and Kias and everything in between. Hannah joins us on Zoom from Los Angeles this afternoon. Hannah, before we get to your favorite cars that you got to drive last year, talk to us a little bit about where we are when it comes to the auto industry. Why was 2023 such a big year for the auto industry?
Well, great to talk to you guys. And in short, where we are is the most exciting time we've ever seen in the history of cars. If you ask me, we're seeing, of course, the most safe, the most efficient cars that we've ever had available at pretty fair pricing for consumers. A lot of choices, a lot of opportunities to bespoke if you want to spend a lot of money. There's a lot of variety. 2023 was finally a year where we have a lot of EV and plug-in options. So, I mean, gosh, there's so much to choose from. It's a really exciting time, and we've really hit an inflection point when it comes to electric vehicles, where we're headed. So I'm having a lot of fun. I know you guys are too.
You do have the best job in the business. Well, I just want to do a little pushback because we often come on and we're like, electric vehicles, they're still really expensive. And I know Elon has cut his vehicles. There's the tax credit that's still out there. But it does feel like on the high end, they're still a little pricey.
They are pricey. There's no denying that. I will point out that last year we had 14 million electric vehicles sold globally, which is up over 30% from the previous year. So you are right. We're still a long way from total proliferation or from, electric vehicles not having a premium of a pricing over non-electric vehicles. But compared to where we were, we certainly are making great strides. We're still seeing a lot of vehicles getting federal tax rebates, even though we are seeing fewer this year than last year. So that's a little bit of a tricky thing too. And I will say, to your point, Ford and General Motors have walked back their targets for some of their electric trucks. So again, to your point, yeah, we are seeing a lot of options. We're seeing electric vehicles from Audi, Mercedes, Porsche, all of these great luxury brands. But with the non-luxury, we are seeing some hesitancy a little bit. So again, it's exciting. We don't know what's going to happen next.
Carol, I have a bone to pick. You said to Hannah that we're talking about, EVs being pricey.
Yeah.
Hannah drove a $30 million Rolls Royce. So, a $70,000 EV is like, that's not pricey. Okay.
All right. A little bit of a smackdown. I feel you. All right. So Hannah, let's get to it. You did drive about, you've got 30, I think that you really, really liked. Talk to us about maybe, is there one that's the top of the list for you?
Well, since you brought up Rolls-Royce, I will go toward the easy target, which is the Rolls-Royce Spectre. This is the first electric vehicle from Rolls-Royce. It's a really big deal. It doesn't cost $30 million. It costs closer to $500,000. So, Carol, I don't know if you're going to like it.
I'll take two.
It's all comparative. This is a relative rare air that we're talking about. But the Spectre is, for Rolls-Royce, a really important vehicle because it allows their buyers, and Rolls-Royce says their buyers were asking for it, to really get in on the electric vehicle trend. I did drive this car in Cape Town. It is actually more Rolls-Royce than any other Rolls-Royce I've driven. And I mean that it's totally silent, totally smooth, very powerful, almost 600 horsepower equivalent. In a way, it's like if there were any vehicle meant to be an electric vehicle, it would be a Rolls-Royce. So I really loved it. And I also like how it looked too. A big two-door car.
That thing is cool. Check out Hannah's video, by the way, of her
You had
South
me at Cape
Africa
Town,
adventure.
driving in Cape Town.
That was really cool. You got some wine, right?
I did have a little bit.
Okay,
I'm not a big wine drinker, actually. I can't claim to know what I'm talking about when I talk wine, but I did have a little bit.
Not
Yeah.
when she was
as long as
driving,
you,
though.
yeah, not,
Not
when you
when
were
she was
driving.
driving.
Of course.
No,
Okay.
after only.
I want to go to the Porsche next. The 911 ST. It's the most expensive 911 currently available. What is this beautiful car?
This is, I don't want to say a tribute car because that makes it sound not new. This is a completely new car that is inspired by some racing Porsches from the late 1960s and early 1970s. So it's for the road. It's not a track car. It is for the road. It's made in limited production. Just over 1,900 of them will be made. And it's inspired by these old, very sporty, fun, light racing Porsches. It also comes with a watch if you want to get in on the Porsche design side of things too. But it really is. It's a manual, which I love. It's not electric. This is a fully naturally aspirated, old school analog Porsche. So for the non-EV people who really want a tangible, thrilling drive that feels like you're really driving, like you're shifting and you're hearing things, I really loved it. The ST might be the car for you.
Was it Barbie pink or was it red?
Okay, this is a polarizing color. The one I drove is called Ruby Stone Neo. And Ruby Stone, also known as Ruby Star, is a really historic color on a Porsche. Some people love it. Some people hate it. It is like that raspberry hue.
Yeah.
It's very memorable. You know, it actually looks great in person, I would say.
I just got a new piece of luggage that I think is the same color. We can't.
Cool.
Wait.
Can I go to the G-Wagon?
No, we're going to go to the Kia EV9.
Okay.
There is the G-Wagon, which we would all love to talk about, but we've only got about a minute
I love
left.
to hate G-Wagon.
Kia is on this list. Some would say, sorry, Kia. What? Hannah Elliott? But it's on this list.
I know. This was really the surprise. And maybe this gets around to your first question, Carol, about the affordability of EVs. I was really impressed with the Kia EV9 because it is priced from around $50,000. It's not considered traditionally a luxury brand, but this big 7-passenger SUV was really well appointed. The range and performance figures are very comparable with something you might see at Volvo or Land Rover even. Yeah. So this is Kia kind of punching up in a way. I thought they did a great job. I also just liked how it looked. I thought it was very cool looking, maybe even cooler than the Cadillac Escalade, which is going to go electric in 2024. So there might be a little bit of a competition there. Yeah, check it out if you haven't seen it in person. It's very cool.
And you can read about the G-Wagon and you can read about the
Lambo.
Lamborghini. Yeah,
this is an off-road Lamborghini. It's the last internal combustion engine, the one they're going to make, Carol.
Off-road Lamborghini. I don't get it.
It raises so you can go over boulders.
I do get Hannah Elliott. She's amazing. Auto columnist at Bloomberg Pursuits. Check out her story on the Bloomberg and at Bloomberg.com. This is Bloomberg Radio. Thank you, Hannah.
This is the Bloomberg Business Week podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.